Good morning, good afternoon, and good evening, traders. I trust and hope that you're all doing well. Today, we're going to jump straight into this week's market prep, particularly focusing on the dollar, the euro, and on gold. And so, we're going to be breaking down these markets from a fundamental as well as a technical perspective. So, be sure to stay tuned and feel free to pop any questions that you have in the comment section below. And with that being said, let's jump straight into it. Okay, so starting off with the dollar index, we can actually see that the market is responding quite well to the third touch at the bottom of the ascending channel. And this level, we've been kind of emphasizing the relevance and importance of this particular pattern from the times that I've been publishing videos on TradingView, but also recent videos that I've published on YouTube as well. And so one of the key drivers that could see the dollar actually build a bit of momentum to the upside beyond this point are some of the most recent data releases. Typically, if we scale over into the daily time frame, we're going to get a clearer view on how the dollar's been performing, testing the 50 period moving average over here, forming a bit of a call it tweezer top if you'd like, rejecting the 50 period moving average that we have on the daily time frame. Now, the question that we're faced with is this going to be the area that the market is going to start reversing? And we're going to see the continuation of the weaker dollar. However, I would beg to differ just looking at how Friday's candle closed over here. We can see that we have seen the market give us a beautiful shooting star or high test candle over here, rejecting the 50 period moving average for the second time in a row, subsequently pushing the price down until we had positive data coming out in the form of retail sales and jobless claims that gave the confidence back into the dollar, resulting in a little bit of a blip to the upside. Now, could this be seen as the catalyst to build momentum further? I would argue that I would need to see a break of the 50 period moving average, a definitive break. And once we've seen that definitive break on the daily time frame of the 50 period moving average, then we have clear direction as to see how far the market can actually go. Now, this particular bias is supported by the fact that we do have a little bit of mixed signals as it pertains to what's the Fed going to do in terms of rates, especially considering that one of the Fed officials, Governor Waller, hinted that a potential rate cut is due to slowing job growth, and this has briefly pressured the dollar during the Asian hours of Friday morning. However, market expectations shows that traders are still pricing up a 50 basis point rate cut this year still. And obviously, this upcoming Fed meeting that is scheduled to happen this week, there is a strong probability that we're going to be seeing the Fed hold rates as it is. And so if we jump over to our Fed Watch tool over here, we can see that there's a 95.9% chance that the Fed is likely to hold rates as it is. And if we go over into our calendar over here, we can see that come Tuesday, we got Fed Chair Jerome Powell speaking, which is going to be a very crucial discussion and meeting, and provide a lot of traders and investors with unique insights as to what the Fed's decision is going to be moving forward. Now, with that being said, if we scale over back to the Fed Watch tool and we just jump over to September, you will have noticed that for the longest time we've seen that there is a very healthy chance that we saw a high probability of a Fed rate cut happening in September. But since data has been released that came out positive for the dollar, we've seen that the chances of seeing a Fed rate cut happening in September has now substantially reduced, with a 47.1% probability of rates actually remaining the same, and only a 50.8% chance of rates changing by 25 basis points. So what this tells us is that the way things are moving, the Fed is a lot less likely to cut rates than they are likely to cut rates. However, when we move deeper into the year, it's more clear that we are expecting a rate cut, and with that rate cut being expected, we have a lot of traders and investors kind of pricing in existing interest rates leading up to the anticipated rate cut that we have scheduled to take place later in the year. And so that is why this discussion that we see on Tuesday is such a pivotal discussion. It's such a pivotal event because it's going to give us more insights and more clues into what the Fed is actually going to be doing with interest rates moving forward. And so when we're looking at the dollar index from that perspective, suddenly we can actually see why there's a strong chance of the dollar continuing to get stronger, considering that we are unlikely to see a rate cut happening in July, August, and possibly even September as well. And so these are all factors that we need to account for when we're looking at these markets. So that's the dollar index. Let's jump over now to gold and have a look and see what's happening over there. So let's just get over to that side of the screen. So, as we mentioned, jumping now over to gold, there's a lot of things that we need to account for, especially now that we've discussed what the Fed is likely to do in relation to interest rates and how that's ultimately going to be affecting the market moving forward. So, because there's a lot of conflicting Fed signals towards cutting rates or keeping rates the same, this has forced gold as a safe haven to remain range bound, trading between what we can see as 3360 and 30, call it 3300. And so this is the two levels that gold has kind of been ranging between. And so the question that we face with now is what's going to happen? Are we going to see gold kind of break out of the 3360 resistance area to kind of start building momentum to the upside? And the one thing that does form part of gold's or kind of falls in gold's favor is the most recent tariff that Trump has implemented with a 50% tariff on copper for copper imports into the US. And so this doesn't necessarily pose well for the dollar in the short term. Or I should say in the long term, in fact. And this is also coupled with the fact that central banks are constantly, um, you know, growing or increasing their gold reserves. And these are all factors that in the long term is going to serve gold a lot better. And so we're not looking at a complete reversal in the dollar. We're just looking at the current data releases that's scheduled to come out and how that's going to affect the dollar in the short term. But when we look at those impacts in the long run, it's unlikely that the dollar is going to be able to maintain the bull run that it's seeing right now, especially recovering from the bulk of losses that it's incurred throughout the first half of this year. And so my overall bias on gold is definitely to the upside, but I'm not holding my breath at this present point in time, because from an economic and fundamental perspective, and even to some degree a political perspective, geopolitical perspective, I should say, things does look good for the dollar in the short term. But when we scale over to gold and we see how gold has been responding to 3360 as a resistance level, we've had multiple attempts of price wanting to breach this resistance area. Now, considering the fact that if we jump over to the calendar, we do have jobless claims that is scheduled to come out. Now, jobless claims last month came out a lot better than they've expected, and this has propped up the chances of rate cuts happening. Sorry, this has propped up or decreased, I should say, the probability of rate cuts happening closer to September, with positive jobless claims coming out last month. But now but now we're waiting to see how jobless claims are going to be performing with this particular data release, and then also we have manufacturing PMI that's also scheduled to come out, with non-farm payroll scheduled for next week as well. So there is a bunch of US data that is lining up that's going to give us clearer insight as to how the market is going to respond, and how the Fed is going to make decisions based on this data that is scheduled to come out as well. And so my overall view for gold is that I'm not actively trading it at the moment, only because of the fact that we've been ranging for the longest while. And when we scale over into the intradays, you can see that it's very, very choppy. I wouldn't necessarily trade this type of price action because in terms of direction, it's not clear. And so I'm not going to try and anticipate what's going to happen in the short term and try and take advantage of it now, but much rather looking for definitive direction by seeing key levels get broken, with the fundamentals lining up to support the market to move in that direction. And so my view on gold is that we are likely to remain stagnant up until such time where the dollar kind of shows its hand and the Fed kind of indicates that it's now time to start cutting rates and trimming rates. And then from that perspective, we're obviously going to be seeing gold build momentum further and further to the upside. But for now, I won't be surprised if we continue kind of fluffing around between 3360 and 3300 as key areas of support and resistance. A break outside of these areas definitively is going to result in me kind of re-looking at gold and in determining, does the fundamentals support what's happening technically, and can the fundamentals push the market in that direction with more authority, I should say, if I can put it that way, and more conviction. Because at this present time there's a lot of uncertainty, as I mentioned, with one of the Fed officials stating that we are now in a position where we need to start considering cutting rates. But when the data gets released, we see that the other Fed officials are voting the opposite way, the opposite direction. And so these are things that we need to account for, especially when we're trying to anticipate where's the market going and what is the risk appetite, and the overall risk sentiment of investors and traders as they kind of participate in the market. So that's the view that I take currently on gold. Let's jump over now to the euro dollar and have a breakdown of that and see if there are any opportunities over on the euro dollar. So finally, jumping over onto the euro dollar, we can see that last week we closed a bit of a doji candle, and this was after testing the previous resistance or the previous high that we saw in April the 25th, at 115.70 as a support now. So a beautiful break and retest of that level, giving us a fairly positive response. Scaling now over into the daily time frame, one of the things that we can see happening is that the market has found that support, giving us a beautiful tweezer bottom over here, contrary to what we've seen on the dollar. However, I still see a bunch of negative momentum coming in on the euro. Now, it's very important to disclose the fact that I am and have been in a euro short for a good while now. This has been since the 7th of July. So I've been, for the bulk of the month, I've been in a euro short. But the overall bias that I have is not to see the euro give us a complete reversal. The opposite is actually true, in that I actually have a long-term bullish bias on the euro. If we jump over into the quarterly time frames, we can see that we've successfully broken above and closed above the quarterly 50 period moving average. We've seen that the euro has closed, I've broken the range or the key resistance area of 111.70, or I think it's 111.90. Yeah, 111.90 break gave us a beautiful break of 111.90, and I was just trading the retracement. The market had a lot of positive momentum. It had a lot of influx of buyers in the recent times, and so it's kind of peaked over here. And one of the technical reasons that I shorted it was because we had this beautiful bearish MACD divergence. Although we didn't have a definitive high or resistance that it tested, this did come well in time for me to kind of look at the euro from a fundamental perspective, because we see that the headlines of inflation on the euro at 2% year to year, it was steady, but at the same time, no strong inflationary pressure to prevent rate cuts. And so the ECB lookout for the euro is that it's expected to hold rates as is for now, but possibly cut rates in September. And this is one of the reasons I have a short bias on the euro in the short term, or a seller's bias to the euro in the short term, because unlike the dollar, where there is still a bit of discrepancy, there is still a bit of uncertainty and indecision in relation to what is going to happen come September with interest rates, the weighting has now fallen on the fact that the dollar is likely to keep rates as is. Whereas just looking at what we've seen with the ECB, most recent talks, the possibility of seeing rate cuts in September is slightly higher. And so that does support my short-term bias to the downside on the euro, and my short-term bias to the upside for the dollar. This until we have clearer kind of indications as to what the central banks of these respective countries are actually going to do. And so one of the things that we can also kind of attest to is that Friday we did have a lack of new euro data meant for the pair, followed by the trend that we've seen on the dollar closing the week on multi-week lows. This is for the euro now. So the euro has closed on multi-week lows, where the opposite is true for the dollar, where we've seen the dollar actually close on multi-week highs. So if the Fed stays firm and the euro data remains soft, then the euro is likely to continue its descent. However, if the Fed begins to shift its bias and kind of lean towards a rate cut happening in September, it's likely that we're going to start seeing the euro build momentum to the upside. And so this is why this is such a pivotal and critical week for the dollar and the euro, because we do have US data coming out, and then we also have European data, CPI, coming out on the 1st of August. Just going back to this week, in fact, we have the ECB decision rate, the interest rate decision, which, like we said, for now, it's likely to remain the same. However, this is also going to be where we need to pay a very close attention to what the ECB is going to be doing with the rates moving forward. And so this is why I say this is such a pivotal week, because it's going to provide us with unique insights as to what we can potentially expect the central banks to do with rates and how this is ultimately going to be affecting these pairs. And so from a technical perspective, I do see that the euro has the potential to drop a little bit further, considering the fact that we do have stronger US data relative to the data that's been released on the euro as well. And then also from a technical perspective, there's certain confluence factors that hasn't yet been fulfilled that doesn't give me enough reason to cut the trade short or exit the trade prematurely. I still see a bit of downside from a technical side. And so with all that being said, guys, I do hope that this little video made sense. I hope that it brings context to your analysis and give you some insight as to how you can view these pairs moving into this week. So for the most part, I hope that you guys have an awesome day. Have a brilliant start to the week, and I look forward to chatting to you all soon. Up until then, keep well, and bye for now.